Hey everyone, and welcome to This Explainer. Today, we're diving headfirst into a really pressing, honestly kind of complex topic, the 2026 American Economic Outlook. If you follow the financial news at all, or, just look at your own bank statements at the end of the month, you're probably getting some incredibly confusing signals right now about the actual health of the country.
And that leads us straight to the big question, keeping economists, homeowners, investors, and really just everyday Americans awake at night. Are we heading into a recession? Honestly, if you only glance at the headlines, well, they claim the economy is doing great. It's booming. But when we actually dig into the underlying data from our sources, the answer becomes a much more complicated reality.
Now, what's really interesting about this slide is it shows how we are living in this massive dual reality. Over on the left, on paper, official data shows positive GDP growth, relatively low unemployment. It sounds fantastic, right? But contrast that with the right side, personal reality. Americans are dealing with record-breaking credit card debt, sharply falling consumer confidence, and this daily, very real struggle just to afford the basics. There is this severe disconnect between the on-paper economy and the actual financial strain everyday people are feeling. To understand why everything feels so off, we really have to recognize a fundamental rule of economics. GDP is a lagging indicator. What that means is it tells you where the economy was months ago, not where it's heading next. It's kind of like looking in the rearview mirror. While that GDP number looks healthy looking back, it masks an immediate, on-the-ground reality. Consumers are actively cutting back right now. Restaurants are seeing slower traffic, retail is weakening, and families are putting off major purchases and big vacations. And this brilliantly illustrates why that consumer pullback is so alarming. Take a look at this. Consumer spending drives nearly 70% of the entire U.S. economy. Because we rely so heavily on the American consumer to keep things moving, any caution, any pullback at all in household spending is a massive warning sign. Once Americans stop spending, economic growth starts slowing down very quickly.
Let's move on to Force 1, the interest rate shock, paying more for the exact same lifestyle. Over the last few years, the Federal Reserve aggressively raised interest rates to fight off inflation, and the results have been jarring to say the least. Look at this jump. A 30-year mortgage that once carried a nice 3% rate has violently leaped to around 7% in a lot of cases. Credit card interest has exploded. Auto loans are hitting completely unaffordable levels. Every single one of these rate hikes violently pulls money directly out of consumers' pockets just to cover basic debt repayments. And if you're spending hundreds more on debt every month, well, you're spending hundreds less out in the actual economy.
Which brings us to Force 2, the permanent price floor. Inflation has cooled, but prices haven't dropped. We hear this all the time, right? Inflation has cooled. But here's the thing. A lower inflation rate doesn't mean things are suddenly cheaper. It just means they're getting more expensive at a slower pace. So your financial reality? It's completely valid. Daily costs are just refusing to retreat. Think about your groceries, car and home insurance, your monthly rent, healthcare, the electricity bills. The actual price level never went back down to where it was a few years ago, and this is exactly why the economy feels so bad on a daily basis, regardless of what the official inflation percentage on the news says.
Which leads us to this really harsh truth for the American worker. Their paycheck may be larger on paper, but it buys less in real life. Real wages haven't fully caught up to these significantly higher prices. Millions of workers have quietly lost a huge chunk of their purchasing power over the last few years. You know the feeling. Your raise gets entirely eaten up by your higher grocery and insurance bills before you even have a chance to save a dime of it. And when consumers are squeezed this hard, it triggers Force 3, collapsing confidence, the slowdown behind the scenes.
This deep sense of caution is currently paralyzing businesses all across the country right now. Look at these sectors. In tech and finance, we're seeing slowing hiring and widening layoffs. For small businesses who are getting absolutely crushed by those higher borrowing costs we just talked about, bankruptcies are rising. And over in commercial real estate, office buildings are still sitting partially empty, which puts massive pressure on banks and landlords. Because of all this, unemployment is starting to slowly creep up, and loan delinquencies are climbing to pretty unhealthy levels.
Now, if you're still wondering why everything feels so incredibly difficult despite all that GDP growth we mentioned earlier, here is a real aha moment for you. GDP per capita. By definition, this is a country's total economic output divided by its population. So America's total economy might be growing, but when you divide that growth across the entire population, the average person actually feels poorer. It perfectly explains why you might feel like you're struggling to save and retire, despite those headlines screaming about positive economic growth. All of this puts the Federal Reserve in an impossible balancing act, which we can call the Fed's trap. On one hand, if they keep interest rates high to make absolutely sure inflation is dead, they risk causing a deep recession. But on the other hand, if they cut rates early to try and save jobs and businesses, inflation could surge all over again. Historically speaking, this exact scenario is exactly where catastrophic economic mistakes tend to get made.
So the crucial point is understanding what happens if things go wrong. Economists are deeply worried right now about a scenario called stagflation. This is a very painful economic phenomenon combining slow growth, high consumer prices, and weak consumer confidence, all happening simultaneously. It is the ultimate worst-case scenario that economists fear is brewing just beneath the surface.
Okay, moving on to the life raft, strengthening your personal finances for 2026.
Let's shift the tone a bit here. We've talked a lot about macroeconomic dread, but now it's time for some microeconomic empowerment. It's time to build your financial life raft for 2026. Based on our sources, here are clear, actionable steps. Number 1, aggressively pay down high-interest variable debt. Carrying credit card debt at 20+% is an absolute emergency. Number 2, build a cash emergency fund. Look, during an economic slowdown, cash becomes incredibly valuable. It is your safety net. And number 3, stay disciplined and patient with your investing.
And on that specific point of investing, I really want to reassure you, market volatility is absolutely not the same thing as permanent loss. Yes, for sure, recessions generate a lot of fear, but they also create generational opportunities for long-term investors who can manage to stay calm, stay disciplined, and stick to their strategy while everyone else is panicking.
Now, I do want to remind everyone that a full technical recession is not guaranteed. It's totally possible we manage to avoid it altogether. However, the margin for error right now is razor thin. A sharper rise in unemployment, another sudden inflation spike, or a quick drop in consumer spending, any one of these shocks could completely change the situation overnight. So the data isn't telling us to panic, it's telling us to pay attention and prepare. And I want to leave you with this one thought to really consider today. Is your financial foundation strong enough to handle what comes next? Take the time to assess your situation and build that life raft. Thank you so much for joining me for this explainer, and I'll see you next time.